Hello and welcome to this talking point where we're going to be looking at the tax implications for a trust and trust loan accounts. Now, investing in property is obviously an excellent way to grow your wealth over time, but it's essential to understand the tax implications of your investment decision. In particular, if you're using specialized trusts like we do as part of your investment strategy, it's crucial to understand how these taxes will impact your returns long term. Now, trust and loan accounts can offer unique advantages and disadvantages when it comes to taxation. So while trust accounts can provide a tax benefit by reducing your estate tax liability or death costs, as we like to call it, it also allows for a tax-free growth, and the loan accounts can offer tax advantages by enabling you to deduct the interest paid on the loan from your taxes. Now, in this video, we'll explore the ins and outs of trusts and loan accounts and discuss how taxes can impact your investment decisions. So whether you are a brand new investor who's looking to invest in property or you've been doing it for some time, understanding these tax implications of trust and loan accounts is essential to make sure you have an informed decision. And before we mention that, if you don't know, we do have a free online training where we'll give you a lot more information, but stick around to the end of the video for that. We'll also explain to you how you can utilize all of our experts in this investment journey, where you can have accountants, lawyers, and property experts all helping you to get the right product at the right time, the right price, in the right structure to make sure that you are doing a successful investment. So stick around to the end of the video for that. But for now, I would like to welcome our trust accounting specialist, Shantel Nell, who's going to talk to us a little bit more about loan accounts. So Shantel, thank you so much for taking the time to join us today.
Good day, Damien. Thank you.
So Chantal, diving right in, can you tell us what is the difference between a debit and credit trustee loan account in a trust?
So credit loans means that the trust owes the trustee or the beneficiary the amount reflecting on the annual financial statements. A debit loan means that the trustee owes the trust the money.
Now, Chantal, tell us, does the interest need to be raised on all of the trustees or beneficiaries when we're looking at that loan?
Yes, it does. So Section 7C is applicable from the 2018 financial period, which means that interest needs to be raised on all credit loans between trustees or beneficiaries and the trust. Interest is also calculated on a monthly basis accordingly to the repo rate +1.
Now, Chantal, obviously every year you get a 100,000 Rand donation exemption. So can that 100,000 Rand donation be used to reduce your interest on the loan?
Yes, if the interest amount falls below the 100,000, then the donation that is available to the trustees can be used to decrease the loan account. In other words, if the interest amount is, for example, 20,000 Rand, 80,000 Rand can be donated. If the interest amount exceeds the 100,000 Rand, then the trustee must declare the amount above 100,000 Rand in their personal name as interest received, and that will form part of their personal taxable income.
And can a trustee take that loan and split it between family members and spouses?
Yes, so if a loan is split between spouses, there are no tax implications. But when a loan is split between other family members, 20% donation tax is applicable on the trustee's name.
Fantastic. And the last question we have is, how can we reduce your credit trustee loan?
Okay, there's more than one way to reduce a credit loan account. This can be done with an annual donation, or if the trust has the necessary cash flow, it can be transferred to the trustee. That will be seen as a repayment of loan.
Fantastic. Chantal, thank you so much for joining us today. We hope you found this quite informative and will help you in your investment journey. So every week we like to keep these short and sweet, give you little nuggets, but a nice reminder that we also want to let you know that there is a free online training available to you. You can just click on the link in the description below, and that gives you a whole lot more information about using trust or specialized trust for property investment. And we also look at the tax implications and how you can pay less tax legally within those trust structures. This training obviously will give you a lot of valuable insights and strategies to make sure that you're a successful property investor. And like I mentioned, also a lot of information on tax and the legalities thereof. So to stay up to date on everything related to property investment, we also encourage you to subscribe to our channel. and you will get ongoing information, tips, and resources that can help you achieve your investment goals. So that's it. Thank you once again for joining. We look forward to seeing you in our next video. And Shantel, again, thank you so much for your time.